Something interesting happened last week. Momentum stocks sold off about 10%. And on the other hand, value stocks, first 3 days of last week, went up about 7%. This was one of the sharpest 3 days shift in the last 30 days from momentum stocks to value stocks. Momentum stocks outperformed value stocks for the past decade almost. It just might be that we are seeing now a rotation between momentum into value that it is to stay with us for a while. As long as the backdrop of our economy is strong numbers of unemployment of about 3.7%, as long as the economy is still growing 2 to 2.5% at a minimum this year, and corporate earnings growth is a positive 5 to 6%, as long as companies keep paying their dividends and increasing their dividends and buying back shares, as long as these fundamentals are in place, we might have a situation that value can continue outperforming momentum stocks. One company that comes to mind that falls within that value category is AT&T. AT&T is selling at about 10 times earnings today. They are expected to make in 2020 about $3.62 a share. If you give that company a multiple of 13, 14 times, the stock should be today at about $50 a share. And yet, there was an activist last week, Elliott Management hedge fund, run by Paul Singer, that revealed a stake in AT&T of about $3 billion, which equals about 1% of AT&T's market cap. AT&T's market cap is $280 billion. You might think that 1% stake in AT&T won't buy Elliott Management Company much leeway to influence AT&T, but I think it will. Because everybody wants to make money, and AT&T wants to satisfy the relentless need of the shareholders to see that stock going up. And therefore, we as a firm need to look at AT&T as an interesting play, a value play, in particular due to the fact that there is maybe a rotation between momentum stocks into value stocks. AT&T nowadays pays about 5.5% dividend. One of the shortcomings of AT&T is that they have a total debt position of about $180 billion because they made two mega purchases in the past few years. They bought DirecTV and they bought Time Warner. That made them one of the most indebted company in the world. Their free cash flow yield is about 10.5%, which translates to about $26 billion in free cash flow. Their dividend payment to support that 5.5% is about $14 billion. In other words, the dividend coverage ratio is about 180%. They have plenty of money to continue at this point paying their dividends and have some money left over to actually increase the dividend payments to the tune of about 2 to 3% a year, and have even after that some more money left over to institute a buyback to invest in their 5G opportunity, to invest in their content, in streaming. AT&T has about 170 million direct-to-consumer relationships. They are going to start introducing to us late in 2019 their streaming service, which is the HBO content. They are going to start reducing the content they sell to other competitors, such as Netflix. They are going to start working on replacing satellite TV installations with a self-installed Android-powered video box that hooks into a standard broadband line to better streamline all these extra services that they have. The Elliott Management Company thinks that if AT&T will start investing in efficiency, trying to cut costs, laying off some employees, selling the satellite division that they just bought. If they were to do all of that, Elliott and Company thinks that the stock should be at about $60 a share. To be more realistic, any price between 40 to 60 is a price per share that I think is achievable. So AT&T is just one example of a value play with a growth kick to it that can benefit investors in a market such as the one we are in.
Typically the cycle for Apple is that they announce their software in the spring and then their hardware lineup in the fall, and staying true to that, the first week in September they did so. Starting with the iPhone 11 Pro, it features a 3-lens rear view camera for ultra wide shot features. The display features an LCD liquid retina panel, and that comes out at 450 pixels per inch, so it is actually building upon what you received in the former iPhone model. This does provide in the display wide dynamic range, and it's called Super Retina XDR, so a lot focused on the visuals as well as the camera in this model. 120 degree field of view. Pro uses the new A13 Bionic Processor, beautiful for machine learning capabilities. And the Pro starts at $999. They also announced the Apple Watch Series 5. It features an always-on display, which is really interesting. They have a new technology that actually runs at very low hertz, even 1 hertz, to refresh only when needed, and can save lots of power and keep what's on screen on the display of the device.
There are many companies nowadays that are stepping into that streaming service. Some we know already, such as Netflix. Others last week came out with an announcement that is Apple, their Apple TV at $4.99 per month. And then we have Netflix with their services at about $12.99 per month. Disney Plus that will launch service in November, and they will charge us about $6.99 per month. So some individuals out there might say that the Apple TV might reshuffle the deck for all these companies. I'm not so sure, and we need to be careful about Apple and their services, because for the $4.99, at this point, Apple only offers us about 9 TV shows. They don't have enough content, as opposed to Netflix that has about 5,500 shows out there, and Disney that has about 7,500 TV shows and about 500 movies. It's actually a lot cheaper than the $4.99 that Apple wants to charge us per month for only 9 shows out there.
So today I thought I'd talk about the services segment of Apple's business, specifically Apple TV Plus. And it looks like the market reacted pretty well, right? Stock is up 3% in the past week. And on the day of the announcement, Netflix and Disney were both down 2% because investors were excited that this is the cheapest streaming platform on the market. Now, another thing I wanted to talk about is the financial ramifications for their new discount package that they're going to be offering. So basically, if you buy an iPhone, an iPad, Apple TV, Mac, iPod Touch, they're going to give you a year free subscription to the streaming service. Now, what that's going to do is that's going to reduce the top line of the iPhone segment of their business, because they're going to allocate 95% of the discount to the hardware they're selling. That's how accounting rules work. So let's say they sell a $1,000 iPhone. Instead of recognizing the full $1,000, they're going to be recognizing $943 if you do the allocation percentage, and the remaining $56 towards the streaming revenue. That could have a detrimental impact on their earnings per share, on their profit margins. That's not to mention that the $56 that will be recognized as streaming revenue will be initially recognized as a liability on their balance sheet and will only be recognized as revenue as time goes on. We might be having a disappointing financial results in the next quarter.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. As always, if you like the content, become a subscriber. Do not wait. Also, you can call us directly to our main offices at 818-914-7461. The highlight of the week is that investors, please pay attention to a possible rotation in the marketplace from momentum stocks into value stocks. If that is the case, markets investment philosophies will start changing.